Something strange is happening to the world of money. For centuries, one simple rule remained unchanged. If you wanted help managing your finances, you turned to another human, a banker, a financial advisor, an accountant, someone with years of experience making decisions that could shape your future. But today, millions of people are doing something that would have sounded ridiculous just a few years ago. They're asking artificial intelligence what stocks to buy. They're using AI to build investment portfolios, create monthly budgets, reduce taxes, plan for retirement, and even decide whether they can afford to quit their jobs. And in many cases, the answers are surprisingly good. Some AI-powered investing platforms now analyze thousands of companies in seconds. They monitor market trends around the clock, detect unusual trading patterns, rebalance portfolios automatically, and process more financial information in a single day than a human advisor could realistically review in months. At first glance, it feels like the future has already arrived. After all, humans aren't exactly known for making perfect financial decisions. We panic when markets crash. We chase investments after they've already gone up. We spend more than we should, save less than we need, and let emotions influence decisions that should be based on logic. So the idea seems almost obvious. If emotions are the biggest enemy of wealth, why not let a machine make the decisions instead? But that's where the story takes an unexpected turn. Because while AI is becoming incredibly good at understanding markets, it still doesn't understand something far more important. It doesn't know your fears. It doesn't know your ambitions. It doesn't know how you'll react when your investments suddenly lose 30% of their value in a single month. And that difference may determine whether AI becomes the greatest financial tool ever created or one of the biggest financial risks of the next decade. The financial industry is changing faster than most people realize. Banks are investing billions into artificial intelligence. Hedge funds are racing to build smarter algorithms. Fintech companies are replacing traditional advisors with AI-powered platforms. Even governments are beginning to explore how artificial intelligence could reshape financial regulation. This isn't some distant future. It's happening right now. The question is no longer whether AI will become part of your financial life. The real question is how much control you're willing to give it. Because once you understand what's happening behind the scenes, you'll realize this isn't just a story about technology. It's a story about trust. Trust in machines. Trust in data. And ultimately, trust in the decisions that will shape your financial future. Before we can answer whether AI deserves that trust, we first need to understand something much deeper. Why have humans been so bad at managing money in the first place? If making money were only about intelligence, the world's smartest people would also be the world's richest. But history tells a very different story. Doctors with six-figure salaries retire with little savings. Engineers who can solve incredibly complex problems fall into credit card debt. Even professional investors, people whose entire careers revolve around financial markets, often struggle to outperform simple index funds over the long run. So what's going on? The answer lies in something economists ignored for decades: human psychology. Money isn't just about numbers. It's about emotions. Every financial decision we make is influenced by fear, greed, hope, regret, confidence, and sometimes pure panic. Imagine this. A stock you've owned for years suddenly drops 20% in a week. The news is filled with headlines predicting a market collapse. Social media is flooded with people saying, "Get out before it's too late." In that moment, your brain isn't calmly calculating probabilities. It's trying to survive. This reaction is deeply rooted in human evolution. Thousands of years ago, responding quickly to danger kept our ancestors alive. But in modern financial markets, that same instinct often leads investors to make the worst possible decisions at the worst possible time. History is filled with examples. During the dot-com bubble in the late 1990s, investors poured money into internet companies with little or no profit because everyone believed prices would keep rising forever. Then reality hit. Billions of dollars disappeared almost overnight. A few years later came the 2008 global financial crisis. Fear spread across the world. Many investors sold their portfolios after massive declines, locking in losses just before markets began one of the strongest recoveries in history. And in 2020, when the COVID-19 pandemic shook global markets, panic selling returned once again. Yet those who stayed invested often recovered far faster than anyone expected. The pattern repeats because human behavior rarely changes. We buy when everyone feels optimistic. We sell when everyone feels afraid. Ironically, successful investing often requires doing the exact opposite. Psychologists call this loss aversion. Research has shown that people generally feel the pain of losing money much more intensely than the pleasure of gaining the same amount. Losing $1,000 hurts far more than earning $1,000 feels good. And that's exactly why AI has become so attractive. Unlike humans, it doesn't panic, chase hype, or make emotional decisions. But does that really mean it makes better financial decisions? That's the question that changes everything. AI can process thousands of earnings reports, news articles, and economic indicators in seconds. It can detect fraud, optimize portfolios, automate investing, and help millions of people manage their finances more efficiently than ever before. Major financial institutions like JP Morgan Chase and BlackRock are already using AI to improve decision-making, analyze risks, and increase efficiency. These aren't future experiments. They're happening today. But AI's greatest strength is also its greatest weakness. It recognizes patterns. It doesn't truly understand the world. Financial markets don't always follow history. Sometimes they rewrite it completely. The COVID-19 pandemic proved that. Events nobody expected changed the global economy almost overnight. AI can only learn from data it has seen before. When the future looks nothing like the past, even the smartest system can struggle. There's another problem. Modern AI often works like a black box. It might recommend selling an investment or buying another one without giving a simple explanation that humans can fully understand. Would you trust your life savings to advice you can't completely explain? Then there's bias. AI learns from human-created data. If that data contains mistakes or hidden biases, AI can repeat those mistakes at an even larger scale. Privacy is another concern. To provide personalized advice, AI needs access to your income, spending habits, investments, debts, and financial goals. Protecting that information is becoming just as important as generating accurate recommendations. And imagine millions of AI systems around the world making the same decision at the same time. Buying or selling. Instead of reducing market volatility, they could accidentally make it even worse. History has already warned us. In 2010, the flash crash saw U.S. markets plunge nearly 1,000 points within minutes before rapidly recovering. Automated trading systems amplified each other's actions, creating a chain reaction that humans struggled to stop. Technology didn't cause the problem alone, but it made the problem move much faster. History teaches us an important lesson. Technology doesn't remove risk, it changes where the risk comes from. Now AI is transforming another part of finance. Financial advice itself. Tasks that once required expensive professionals are becoming available through AI-powered apps. Budgeting, retirement planning, investment analysis, tax optimization. These tools are making financial knowledge more accessible than ever before. But the best financial advisors aren't valuable only because they understand numbers. They're valuable because they understand people. They know when a nervous investor needs reassurance. They know when someone's financial goals have changed because life has changed. No AI truly understands those moments. The biggest winners of the AI revolution won't be people who blindly trust machines. And they won't be people who reject AI altogether. They'll be the people who combine AI speed with human judgment. Looking ahead, the future becomes even more fascinating. Imagine waking up while your AI has already paid your bills, invested your spare cash, compared insurance prices, negotiated lower subscription fees, and adjusted your investment portfolio based on changing market conditions. That future isn't decades away. It's beginning right now. But convenience always comes with responsibility. The more we rely on AI, the more important it becomes to understand what it's actually doing. Money has never been just about mathematics. It's about goals, dreams, families, freedom, security. AI can analyze data, but it cannot experience hope. It cannot understand regret. It cannot define what success means in your life. So, should you trust AI with your money? The answer isn't simply yes. And it isn't simply no. Use AI as one of the most powerful financial tools ever created. Let it analyze. Let it organize. Let it identify opportunities and risks. But never stop thinking for yourself. Never stop asking questions. Never stop understanding where your money is going. The future won't belong to people who compete against AI. It will belong to people who know how to work alongside it. Technology will continue evolving. Markets will continue changing. New opportunities will appear. New risks will emerge. But one thing will always remain true. The more you understand money, the better prepared you'll be for whatever comes next. So if AI offered to manage every dollar you own tomorrow, would you trust it? Or would you first want to understand how it makes its decisions? Because that answer may become one of the most important financial decisions of your lifetime.